All right, today we are going to discuss the topic of inflation and rising interest rates and how that can impact whole life insurance policies when maximum cash value is the goal. So the topic of inflation and rising interest rates is a hot topic right now because it's real. We're shooting this video early May, and if we go back to April, even March, interest rates are higher today than they were 2 months ago. Inflation, we don't even need to read anything about it. We can just go to the store and shop for food, and we know that it's real right now. So, how will this impact whole life insurance policies? Will the rise of interest rates continue? And depending on what expert I read or listen to, I hear mixed opinions. Here's what I do know and what I have more confidence in. And I'm going to back this up with some history and conversations and data points I have from insurance companies, some of the major mutual life insurance companies, which are, in my opinion, some of the smartest institutions in the world when you look at how they have their finger on the pulse of the financial markets. I had a conversation, this was December 2019 or early 2020, before COVID hit, with MassMutual. This was right after they had updated their life insurance product portfolio to comply with the new mortality table updates. This was back right around the beginning of 2020. And they made a comment. The comment went like this. The new product portfolio is a bit more dividend sensitive. The reason why, Steve, is we feel, so this is MassMutual, we feel that the low interest rate environment is going to remain low for at least another 10 years. We don't see interest rates coming up over the next 10 years. Now, this was pre-COVID. Obviously, COVID hit and accelerated things in so many different ways. When COVID first hit, interest rates went down even lower than they already were at a very, very fast pace. Now they're starting to come back up. Now, we're in 2022, May 2022. What recently went into effect was the 7702 change. This was an update in the life insurance industry. It mainly impacted whole life insurance products where there has been a reduction of guaranteed rates. The guaranteed rate used to be 4%. It's been at 4% with whole life insurance products really from 1980 through 2021. 2022 now, all new whole life insurance policies have a guaranteed rate that ranges anywhere between 2 and 3.75%. The lower guaranteed rate really allows insurance companies to shift some of the risk away from themselves back to the policyholder. Not to say a whole life insurance policy is risky, but what it does is allow a lower guaranteed rate allows a life insurance company to guarantee a lower death benefit to a policyholder. There's more upside potential based on dividends, but I've got a lower guarantee. So why did that change happen? Well, a big reason why that change occurred is one, interest rates and the environment had been very low for a long time. That was putting a lot of pressure on life insurance companies. Remember, when they go to acquire assets, they're looking for competitive returns for their portfolio, but they're also looking for AAA rated assets. They can't just go dump a bunch of money into the stock market. So when you look at their overall portfolio, you will see companies have a very small percentage of their general account portfolio invested in the market. But for the most part, they're looking at AAA rated investments. It's got to be safe so it does not negatively impact their safety ratings. So again, that 7702 change. Why it occurred is one, interest rates had been low for a while. But that conversation I mentioned I had with MassMutual early 2020, that's a big reason why as well. Companies anticipated that the interest rate environment was not going to increase for a long period of time. They felt it was going to stay low. Not too long after that, literally several months after that, inflation begins, hyperinflation we could call it. And then also what do we have? Interest rates are coming up. So my question as I try to stay calm, let's look at everything. If I'm flying a helicopter, I can look at it from above rather than be in the storm and then I panic, is this just happened right now. If I rewind the clock back about 1.5 years or so, or closer to 2 years, what happened when COVID first hit? Interest rates were hiked down even lower for a short period of time. Now the opposite has happened. Will it continue to go up? Will it flatline for a while? who knows, right? We've got all the different predictions and such, but really who knows? I don't know, and I'm not going to try and pretend that I know. But from insurance companies and what they know, that's really what I like to look at as far as an indicator is concerned. So if interest rates do continue to go up, if we have another period of time like the 1980s, what will happen specifically with dividend interest rates is the question, because this is a good question. Well, when we look at history, what happened in the 80s and 90s? Fortunately, I majored in history in college. I was not alive long enough in the 80s. I was born in 1988. So I was born during a high interest rate environment. That doesn't mean I remember what was going on because I was a baby. But what happened with dividend rates back then? Let's take a look, shall we? So here is Mass Mutual's dividend interest rate history going back to 1980. The guaranteed rate was 4% at this point in time. And depending on the product now in 2022, the guaranteed rate will vary with Mass Mutual between 2 and 3.75%. Now, back to the point. 1980, dividend interest rate 8.27%. What happened throughout the 80s? What could you get a CD for back then? How much was a mortgage back then? Much higher than these dividend interest rates. But interest rates went up, dividends followed. Now, when an interest rate hike occurred, there was a lag between when interest rates actually went up and then we saw dividends follow. The reason why is because an insurance company must acquire assets that are available that can allow them to participate in the interest rate upswing. What they did back then, this was very easy for them. They could just buy long-term bonds and hold on to the things. If I could buy a 20 or 30-year bond that was paying 16% or 18% and hang on to the thing, how easy does that make my life in order to turn around and credit a competitive dividend? Very easy. Now, if you fast forward to today, and really what's happened over the past decade is bonds are really not that attractive. It's difficult for insurance companies to purchase bonds in bulk and still pay a dividend or be competitive there. So we've seen that their bond allocation has gradually come down. If you were to go back to the 80s, you would see a lot of insurance companies have close to about 80% of their portfolio invested in bonds. If you look at it today, so here's several companies, but if you look at your 4 major mutuals, this gives you a nice snapshot of where they're positioning their money. So invested assets, Mass Mutual, they've been just gradually decreasing over the years at 53%. You've got Guardian here, 77%. Then you've got Northwestern Mutual and New York Life. All of those allocations were higher. I said Northwestern, New York Life, then Northwestern Mutual. All of those allocations were much higher a decade ago. I have to go back and reference the exact reports, but they've been decreasing and they've been allocating funds elsewhere. Where can they go that still provides an attractive return? That's the question. This way they can turn around and pay a dividend to policyholders, remain competitive. So here's the dividend history. Let's actually go back, have some fun here. Dividend rates, 80s and 90s, interest rates went up, dividends increased as well. Interest rates though, what was the highest dividend you saw there if we go back to this guy? Highest dividend, 12.2%. If we look at Guardian's dividend interest rate history, let's take a look here. What do we see here? Going back to the 80s on the other side of the screen. I have to scroll down a little bit. There we go. That's better. They stuff it all in one chart, which I don't mind actually. I like that. But 13.25%. Not bad, but if I can get a CD or mortgage back then for 18%, is that competitive? Or would I look elsewhere and say, that doesn't really do it for me? So it was at this point in time where life insurance companies said, hey, whole life insurance, it can't really keep up with the interest rate environment right now. How can we become competitive? Well, what happened is insurance companies came out with what's called universal life and variable universal life insurance, because whole life insurance could not keep the pace. And what you would see with a universal life policy back then is the illustrations look phenomenal. The reason why is that these illustrations could be based on the current interest rate environment. So if I could see a universal life insurance illustration with an 18% crediting rate, how good is that picture going to look? It's going to look phenomenal. So what the illustration depicted here is I had a premium, I would pay that. The cash value would grow over time. We've got that over here in green. And then if I'm at 18%, even 11 to 18%, what happens with the universal life insurance policy? I've got costs that are associated with it. With universal life policies, I've got built in what is called annual renewable term insurance. No matter what happens with the universal life policy, as I grow older, the cost of insurance increases. With a universal life policy, the expenses will always exceed the guaranteed rate on a policy. So I have less guarantees with a universal life, but more upside, more potential. On an illustration, the gains would always outpace the actual expenses. So it looks great. Hey, look at all this money you should have because interest rates are high right now, and the illustrations assumed that interest rates would remain high forever. Now, the reality, what happened, a lot of lawsuits popped up with life insurance companies, particularly with universal life and variable universal life policies. Here's why. Rates came down. The policies delivered less than what was illustrated. People were expecting to have all of this money. Got to set expectations properly. It did not happen. So in short, the expenses exceeded the gains on the universal life insurance policies, and the policies blew up. Policyholders did not have the money they expected to have. They either A, saw their policies lapse, or B, had to pay more premium into the policy to prevent a lapse. People that were using those policies and taking income from them really got into trouble. That's where some big tax bombs occurred. My point is, this is not an attack on universal life. That's not the point of this video. A product was created back then to keep up with inflation and with rising interest rates. Now, with all that said, we've got all this stuff going on, new products. What can I use as an alternative? The industry is trying to keep pace. What stayed the same? Or you've got the hare in the race here, right? Zooming out of the gates, but then it just burns out and loses the race. And then you've got the tortoise, the whole life insurance product. Policies that were issued back in the 80s and 90s produced a net internal rate of return somewhere between 5 and 6%. That was the net internal rate of return. So what I mean when I say that is if we look at some historical policies, right, here are policies that lived this is a 20-year study period. These are actual performance results. This is from a Blease report, which is an independent study. You've got Mass, Guardian, New York Life, Northwestern Mutual up top. There's the actual internal rate of return. This is on a 55-year-old male, 4.2, 4.35. Northwestern, very strong back then, 5.38%. Depending on what time period you look at, here is a policy issued in 1980 from Mass Mutual. This study period runs through 2015. There you go. The annualized IRR is about 4.84%. I don't have the average here, but at this point in time, it was just over 6%. Now, these policies lived through a high dividend rate environment, high interest rate environment. That's a nice advantage there. Today, we're not in a high dividend interest rate environment. So that's why I like to state 3 to 5% regarding the net internal rate of return. My point is, there's always ups and downs. That's always going to happen. Where people often make mistakes is we get caught up in the noise, all of the commotion. I have to make a move right now because I saw someone really time things nicely, whether it's with the stock market or they invested over in this other asset class, and I'm stuck over here in this boring whole life insurance policy. That's where I say, hey, things are really good elsewhere right now. Whole life might not be a fit. Same thing happened back then. As everything calms down, as the storm passes, there's my whole life insurance policy that just kept moving along. Now, this is not to say whole life insurance is the only area we should put money. No, it is a great asset class. The core benefits of the cash value are as follows: safe, liquid, tax-free area to position money, just continues to move over time. So I hope this helped as far as providing a little bit of history as to what has happened with inflation and interest rates in the past. In the future, Who knows what will actually happen, but what we can bank on is a whole life insurance policy. We've got the guarantees associated with the product, and it'll continue to appreciate over time. We've got that safe, liquid, tax-free, reliable asset. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.